So I was going to start with an apology that I've recently migrated from 20 years on a Mac back to Linux. So therefore, I was unable to. I'm not an expert on the LibreOffice presentation, so it feels like a presentation from 30 years ago from a graphics point of view. But then I realized it's actually an AI discussion. So I thought, well, actually, AI can do so many things now. So I'll just ask one of the large language models how to smarten up a presentation quickly. So I asked Mistral, which wouldn't help me, and basically pointed me off to some platforms like Beautiful.ai, whatever, where you had to pay a subscription fee to start with. But Claude said it could do really help me and do a really modern, high-tech sort of theme. And so that's what Claude gave me, which kind of reminds me of my startup from 1999. So I wonder what training data is for high tech. It needs to rethink that. But I was just in the sort of the right place at the right time, doing internet sort of infrastructure. That when the web started, we just hacking around with various ideas, and at that time there was two main ideas about the web. One was disintermediation, where things like eBay and Amazon were cutting out middlemen, and putting the idea was the consumer could go direct to the or consumers together. In the case of eBay or in Amazon, you could far easier get direct access to the books. What we were doing was offering a free URL for the other side, where people were creating websites and trying to market them and monetize them. But we quickly ended up building an ad network. We pivoted very drastically to an ad network, and at that time there was quite a lot of opportunity to. The markets were very kind of inefficient, and you could find opportunities to create value. Now, what after having gone through this startup founder phase as a CTO, I've since 2009 I've been investing in mostly around EPFL, Deeptech startups. So I've called it Deeptech and not Deeptech and AI or anything, because at that time AI was not a word that was being used. And in fact, a lot of the themes here around is sensors, around sense in the name is a bit of a giveaway. Fasttree 3D is sensors. Gamaya was sensors for hyperspectral imaging. There's drones. Drones there, but there wasn't really anything about AI. I mean, I think in fact, when you look at software technology, it's sort of the way that it's been presented to the public, to consumers, or business to business, to investors, was originally sort of algorithms. Then there was machine learning. And now everybody just talks about AI, whether they really have AI or not. And then, so if you go back, a lot of these startups are still going, and a lot of them were, again, if you take companies like Flyability. Flyability now has every Flyability drone has an NVIDIA board on it, and therefore it has some kind of AI navigation. At the moment, the main AI navigation that's live is to return to base at the most efficient way, swap a battery, and then go back to carry on where it was. So this is in some ways it's not a real fully autonomous drone, but it's a solid feature that's very useful for the users. And so, you would have a question at the moment: is Flyability an AI driven company? I mean, the propellers and things are optimized, with AI. It will not have AI kind of in its name. These are all spin outs of EPFL, and then there's also some other startups that I've been involved with as an investor and hands-on, in some of them. In the case of Searchbox, that was started in Geneva, but then moved to the Science Park here in 2009, doing a semantic search platform. So, in some ways, it resembles a lot of a large language model today. It's a probabilistic, kind of language, sort of being able to provide related content and things like sentiment analysis. Although it failed to find any customers at that time. And then there on the list, for example, GradeSense is doing predictive maintenance, so measuring rotating machinery. So in your sort of area where it has the sensors, the data transfer, and the AI algorithms. So that kind of works together as a relatively reliable solution for rotating machinery. Then I want to come on what I wish I'd known right at the beginning is that startups generally have three phases. The initial value and the growth. And what I mean by these and why I call them hypotheses is because initially they're untested and they have to go through a phase of becoming more sure about what you're doing. And initial, because you start off with an initial idea, but it's as a startup, it's not going to get anywhere until you really can show there's actually some value to a group of people. That value can be monetary, or can be the fact that they want to start using it. Maybe it's a free service, ad supported. But unless you can really show the value, you will, as you go through looking for investors, it's very difficult to convince them that they will get kind of a return on this. And then the growth idea is that actually, and that's in some ways the most important, is being able to figure out how to grow the startup and kind of, which essentially means being able to sell profitably the same thing to a group of, into a market. And that's that is really what when we have deep tech startups, quite often we spend a lot of time in the initial sort of phase and just continuing to develop the technology to make it more robust, to add functionality on. Whereas really, I mean, I think this is the challenge as spinning out to going into the real world. The real world wants to know, well, where's the value and how are you going to scale this into proper business. Then, focusing back more on the AI is, I think until very recently, AI for the kind of the real world and for investors, also for us at Innosuisse and Bridge when we're judging AI related projects, is if we went back to up until a year or two ago, generally the AI projects and AI startups were quite simple. Is that it was in order for them to work, is they needed the full kind of training data set, and then they which one in a lot of cases either it wasn't annotated and there was a massive manual work to annotate it, or it wasn't a full data set. It was just a partial data set, which often in the research environment, that's fine that you have you have a partial data set. But when you're trying to productize something, You need full data set. So that was part of the challenge. And the second one was actually, even if you have this full data set, to actually create a product, it might be you have a full data set that demonstrates that the product works, but for each customer, you then have this problem that you have to get their data. They don't want to give you their data and run it on the third-party service, or maybe your business relies on collating everybody's data together to make insights. And this wasn't, this is also, creates a problem going from the lab to creating a startup. One I've also put like arbitrage as an idea. So in some markets like financial markets or also online advertising, they and really crypto type of things, is there you have, if you can train an algorithm on some data, you can access the data where you can trade, and if you're better than the average, then you can make money on it. And even so some ways there are different ways. You don't have to create something where you have to acquire other people's data necessarily, but you can have enough data that you could have traded that. And I've then said there's nothing really magic. Like insofar as kind of normal people who are not AI experts can kind of get their heads, around this, and then from a point of view of how you take an idea or you go to market, there's different approaches. So normally with a spin out, we start with a technology solution and then going looking for where to apply it, a problem where it has value. The more Silicon Valley type of approach or business approach is to go and look for a big problem and where there's a group of people. I mean, this comes back to the kind of the growth and the value hypothesis. They figure out that where much more strongly there's this growth and the value hypothesis, and then they go and look for how could we kind of put some technology together to to solve this. And there's also this is also more of a Silicon Valley way of looking at it, is just to get a team together, which is a hacker, a hustler, and a hipster. So the hacker being the someone who can program and can prototype things quickly. The hustler is someone who can sell anything, like secondhand cars. I mean, really someone who really wants to do deals all day. Really wants to do it. And the hipster is someone who is more focused on design and product type of mentality and wants to make something that users love, people love. So and often you can, especially if you're heading into somewhere where you don't really know, if you have all those competencies together, it helps you pivot into something that closer to where the value is. So it said that's what AI startups used to mean. But when you go now, I mean, I've left this slide blank because I really don't know what to write, because everything's so fast moving. We've gone from probably 6 months ago, the coolest thing was things like LangChain and writing chains and being able to do sort of reinforced learning and things, to now there's agents, there's deep research type of stuff going on. Nobody really knows what works and what doesn't work, especially if you go back to the idea of, is there a full kind of data set? Is there a product that's reliable enough for people? But Claude didn't like my slide here, so Claude wanted to put that on there, which kind of is a bit, I think, is being a bit he would say that sort of, that's a large language model. Use Claude to build your startup. Transformed everything. But again, what I'm reviewing this. This is something that Paul Graham from Y Combinator said probably 15 or 20 years ago, of why startups are interesting. And he's put these figures there, and strange when you do multiply all of this together, you kind of get 36 times faster, and that's why when a startup focuses on one thing, it can outperform larger companies. They just can't compete. Now, whether this is right or not, it probably is where someone like Elon Musk is driving people that won't let people leave the building, sort of for weeks on end. But I also wonder now, with going back to the slide, there's no about AI now, where I haven't put anything down. There, we do actually have the ability to use. We're hearing of, especially like the Silicon Valley type of startup, where everything is driven by AI. The code's all being written by AI. All the marketing's kind of been written by AI. And I think we probably are in a phase where if you really have a core team with that is really thinking AI first, and I think you probably have a better opinion on this than me. Maybe we are in this sort of phase. Clearly, in this sort of phase, is you can just build stuff so quickly. You can figure out what people want with really. I mean, we're not talking about A/B testing. We're talking about A, B, C, D, E, F, G, H, I, J, K, whatever testing, and on a hourly or minute by minute sort of basis, is the ability to move quickly. And this may be, I'm someone that I won't try and convince people to leave jobs, stable thing, and create startups. Except that I mean, one of the things is that in order to be successful, you need this growth to figure out the growth. And one of it is it's around at the bottom. I put timing bubbles. Is we always have technology bubbles, and we've seen in the last. It's almost like it's getting more extreme, the bubbles. So we've gone in the last 4 years with COVID bubble, with AI as a bubble, or at least AI is now sucking in 80% of investors investors' money. But these are some things that you just don't get the growth if you're having to push all the time to each customer. You kind of have to engineer these things. I mean, I put Silicon Valley mindshare, which is when we talk about AI, probably 80% of all the noise is open AI, and a lot of this comes from the fact that there's a couple of thousand journalists in Silicon Valley just going around everywhere. Whereas if in Swiss Romand, how many tech journalists? I mean, has anyone ever talked to a tech journalist? I think there's 1.5 times one looking for Tom. Yeah, but it's very you kind of have to be quite smart about how you kind of address these things. So that's a slide I grabbed from my Mac presentation, so the font's a bit better. And that's also this is one with a startup, and I think why a startup's maybe different to anything else, like in academia or in a large company, is somehow you have to get a startup to work, but you're dealing with trying to get some sort of traction. You won't sell it unless people kind of know about it. You need to be able to hire people and to grow a team and things. And this leads on to why when you create a startup, most people fall to the idea we need investment, because with investment it gives you a margin to figure out everything else. If you don't have those investments, you don't have the margin to figure out. Maybe you can do it by you already know a couple of companies that want to buy this product, or otherwise or you have people who want to work for free. It's difficult. But overall, in this environment, you do have the benefit that people believe in you. If you say we're a couple of EPFL, ETH domain students we're creating a startup in AI, no one will say you don't know what you're doing. If you come from, the middle of kind of nowhere, not one of the top 20 universities, people will always doubt that. And I think we see on the list of, startups that I listed before, the ones I invested, a lot of those have been successful because the research was top grade that went into creating the product. There is, even though it's not the same level as Silicon Valley, there is a strong ecosystem, here with a lot of the initiatives with the Science Park, with VentureKick. A lot of things are happening, and also, when you're young, it's not necessarily a waste to spend a couple of years on a startup that doesn't work, because you learn a lot of hands-on things. You get a lot of experience, and it looks good on your CV. But don't hang out where the investors hang out. That invested. And overall in the ecosystem, there is a lot of finance, that won't take shares initially. So from EPFL, Vo has a lot of support, Innosuisse and Bridge. At Innosuisse, we have a budget that a lot of it does go to EPFL and ETH for startups and startup coaching, which probably is around about 100 million would go into the ETH domain a year to support startups, either directly or via innovation projects or via coaching. There's the mentoring, the ability, which is something that just didn't exist back, even in 15 years ago, to have any mentoring. And now these are you can find mentors in the Innosuisse ecosystem who really have the expertise, including AI. But and then there are incubators and accelerators in every city here, and there are investors. So I've listed the main active investors in the seed area for initial startups. I think.
Hi everyone. Thanks, first of all, again, Josie, for organizing it, and thanks, David, for your talk as well. And Nicholas, where is he? Thank you. I have another Nicholas with me. He's an associate at Verve. So if you have questions on Verve, also both of us happy to dive into it. So what I would like to talk about a bit more, and this is what I liked when I was back at university, is how VCs look at startups, how investors in general look at startups. But I think VCs are a particular type of species in that area because they have their own dynamics. And that's what I'm going to talk about a bit more in detail. Who of you is familiar with the general concept of VC? So not everyone. So a venture capitalist, basically what Dave does, he's a business angel. In terms of the life cycle of the company, you will be starting your own company, you incorporate it, you put in your first 100K in Switzerland at least. Then you go to what we call the triple F, which is friends, family, and fools, that eventually give you some money that you deploy in your business. At some point, the more institutional type of investors come, which is David, like a business angel. They want to see a bit more substance. Basically, David's point of exploration, value, and growth. And then after David, it will be us, the more institutional investors that do this as a full-time profession with bigger teams and the whole machinery behind them. Just to put the bigger perspective. So Verve, as Josie said, we're a deep tech investor. What does deep tech mean? Is a word that is in everyone's mouth these days. There's hundreds of definitions. I also asked ChatGPT this morning what it means. For me, it just means it's something that is hard to replicate. So you build something, be it a software or a hardware. It does not necessarily need to be a hardware always. That's some people are interpreting it that way. That is inherently defensible. So the product in itself, it has a defensible angle to it. Doesn't need to be patents, can be trade secrets, can be databases that you trained and are proprietary. But yeah, we're a deep tech investor focusing on seed stage, active all over Europe. We grew out of Zurich. We're investing in about 10 new companies a year. We have a portfolio of 150 companies that are spread over Europe. Still, half of them are in Switzerland, focused around DTH domain. We do not invest in AI as an industry. We invest in health and bio, which is one of the focus areas that includes a lot of tech bio. We invest a lot in energy and resources companies. Insolite is a company here from EPFL that you might be familiar with. Eco Robotics would also be in that realm. And we invest in the compute area, which is what we call future of computing. Basically, most of you will be familiar with Moore's law. It's coming to an end. So we need to find novel ways on how to compute faster and more. And AI is the underlying technology that goes through all these different areas. So we're not necessarily going to invest in an AI agent or in an LLM, but we believe that you find investment cases in these different areas that strongly leverage AI. As an example, Oracle, a company from Paris that we're invested in, has trained a proprietary data model from a patient sample that they got from a specific hospital to find novel drugs based on that very one specific patient sample that Novartis and Roche don't have. Yes, a bit of KPIs. We can skip over that. That's me. Josie introduced me already. Thank you. Now, what do we look at if we look at startups? I think ultimately it boils, or maybe that's a question to the room, if anyone has an opinion on this briefly. Not everyone at once. Good. Then I'm gonna help you. But before we go into that, we briefly just, what is the goal of the VC? It's the name stands for venture capitalist, and the latter word is capitalist. So we're capitalists at the end of the day. We're trying to make money here. And that's by identifying interesting opportunities. We're investing in them, we scale and grow them. And then ultimately, and that's what a lot of people forget, we need to sell them. So we need to generate returns for the investors that are behind us. It's some of our money, but the largest part is from what we call LPs, limited partners, that give us their money to deploy on their behalf. I think the core VC lens from my perspective, or from our perspective, is focused on three areas. I think the gold medal, and Dave already alluded to that, is the team. The team is absolutely essential for an investment. And why is that? I'll get to that in a minute. And the second is the market. And the third, only the third, is the product. When I was studying still, I always thought, well, product, I really want to become an entrepreneur, but I don't know, I don't have a good idea. If you don't have an idea, it doesn't really matter. You need something to start with, but trust me, you will pivot anyway 3 times on the way there. So it's much more important that you have the right people with you and the right problem, and as Dave said, that you address, which is the market. And underlining is the valuation and the terms. The valuations of the company and the investment terms or investment conditions that the investor is investing in. Because again, it's not philanthropy that we're doing. There is an incentive for us to also get money back here. Now on the team side, and I'm repeating a few things that Dave already mentioned because it's extremely important. I like the analogy of the hipster, hustler, and the hacker, or hacker, hustler, hipster, because I think whilst you can go to a nice corporate, earn 200K with an EPFL degree, and have a 9-to-5 job, in a startup you work 996, which means from 9 a.m. in the morning until 9 p.m. in the afternoon, 6 days a week. So that's the hustler mentality that everyone really, really, really needs to be able to excel. I think the beauty of it is that there is really, you can build something by your own, and you can grow it, and you can hopefully also make a really solid success with it. The experience, I think, whilst you probably read in a school book, well, we need to be complementary, we need a guy or a girl from HSK, we need someone from EPFL, which is a technology person. I don't care that much whether you guys have a complementary skill set on paper. What I care much more is the hacker hipster hustler mentality, which is more the soft skill elements of it. So we spend a lot of time prior to investing with the teams to understand their dynamics, to understand their motivations, even personal situations that they're in, because ultimately you guys are driving it and you guys are the ones that are going to be successful with it. What we hear a lot from the US is also serial founders. Serial founders, there's VCs that only invest in serial founders, meaning companies that founders that have already started a company and either successfully sold or failed it. And the reason is quite obvious. If you've done it once, next time you do it much better. And that's a pattern that is not a pattern, but that's statistically proven that there is a bigger success for serial founders. I think Europe, especially Switzerland in itself, does not have that long of a startup history as US does. So just naturally, there is less serial founders in Europe. The market, and David also said that what we have a lot with ETH and EPFL is you have a product or technology. It's amazing, but there's no problem for it. There's no need for it. And then there's the US approach. And again, I'm repeating what Dave said, but I think it's extremely important. There is a problem, and then you find a solution to it. What you guys will be doing is probably somewhere in the middle. On the way, through your research on your product, you will also think about, well, what's the solution? What's the problem that I'm solving with this? And I think this iterative approach between driving the technology push and the market pull, that's extremely important to note. No investor will give you money, not even maybe the friends, family, and fools. That's why there's the fools. If your solution is not really tackling any type of problem. And then there is obvious big problems to solve, like climate change. And then there are smaller problems to solve, more niche problems that are equally important or are equally big in terms of market relevance. I think generally speaking, and we get to that a bit afterwards when we talk a bit more about the valuation, what we're looking for is big markets. And big markets, if you hear 200 million, 300 million, 400 million, that's not big enough. It needs to be at least 1 billion, 2 billion in terms of potential market size, if not beyond, that you can address with your solution. And the reason for that is you will only be able to grab a tiny portion of that market. So if you grab a 1% market share of a 200 million market, then your potential revenue for the future is 2 million. And 2 million will never result in a proper exit. And we get to this exit discussion in a minute, where you can also return your money to the investors that gave it to you. So big markets. The timing is of essence. I discussed this morning in the train with Nico what good example we could bring. And Nico mentioned that there is, you all know these electronic cigarettes by now, IQOS. There was a solution 15 years ago by one of the big corporates, but the market was just not there. No one cared about electronic cigarettes. Everyone was craving for still normal cigarettes. Now the market is right. And there's plenty of other timing examples that you can look at. And I discussed this morning with Josie on a robotic hand. Is now the right timing to invest in a robotic hand, or is it in 5 years to invest in a robotic hand? Because the technology might not be there yet, might be here yet, and you have to keep that in mind, because you have to survive to that point where your technology is ready and ultimately then being bought by the market also. Pain points, we went into that, trends, hypes. You can ride a hype wave like the crypto hype, but it's very dangerous. Whether AI is a hype or not, many people say it's not, it's here to stay. I would probably be one of that people. But whilst you're on the uprise, you never know whether it's going to tank at some point. So we just don't know. There is obviously opinions on it, but we don't know. The product, I mentioned defensibility. Defensibility is probably associated, as I said, with patents and IP, intellectual property. It does not need to be. It can be trade secrets. It can be your own knowledge that you have as an individual. It can be, as I said, data that only you have. It's not protected, but only you have it. We went into the problem already. I think the innovation element is an important one. We're not looking for an incremental solution. We're not looking for something that is 10% better. I discussed with someone else in the room today. His solution is 10x better than what the market is offering at the moment, and that's exactly what you would want to see. You want to have something which is really fundamentally changing something that is being done today. Faster, cheaper, and therefore also more economically interesting. And often it looks just nice, which I like. So yeah, connecting these three dots is what we're trying to do, underlying them with the value, with the financial elements to it. Yeah. Now, I've been alluding to this a bit, the power law of venture capital. So what are we looking for? And the fact that we need to return the money to the people that gave us the money at some point with a return. And there is always this big 10x number in the room. Probably many of you have heard it. Can you return 10x? Can your company grow 10x? And 10x means the value today. If your company is worth 10 million today, can you sell it for 100 million in the future? And that's what I want to dive into in a bit more detail. Yeah, and to evaluate this, we're basically, what we do is we reverse engineer the future value of your company. So we take a look at your product, we take a look at the market potential, we take a look at the team as we discussed just now, and then we make an assumption on what the future value of your company can be, and then calculate backwards whether that makes financially sense. Because remember, there is people that give us money that could put their money otherwise into the stock market. And in the stock market over the last 50 to 100 years, your average return was anywhere between 7 and 9%. So we have to outperform the stock market in terms of our returns, because otherwise people will not give us the money to invest in high risk startups. And for that, it's important to understand at what point in time do you exit your company. This is not a slide I did. This is the slide that one of our close partners did, an M&A advisor. That is his job. Their name is Menalto Advisors. Their job is to sell companies. And you have basically 2 points in time when you can sell a company. On the x-axis, you see time. At the very beginning, on the far left, you see the initial funding. And on the far right, you have the commercially successful companies that are growing and are big. And on the y-axis, you have the value of your firm. So it's always the three T's, which is team, technology, and traction. Team IP is what we discussed, the product, the market, and the team. And the traction is really the financial progress that you have, the number of clients you have, the revenue that you're generating. And you're basically following, it's almost a bit like a hype cycle, a Gartner hype cycle as well. You're in terms of value of your company, you're following this trajectory. So after you built your technology, maybe you have your first customer, you're basically at what Dave called the value point. So at stage 2, you have proven your value, and you've proven that your technology works and that someone is willing to buy it. And at that point, you are at promised value. You have promised it, but you have not shown that you can scale it. You have not scaled to 10, 20, 30 million in revenues with your business. You might have 1 or 2 million in revenues, which is nice. You might have 3, 4 customers, which is nice, but you're still only at that promise stage. And then comes the well-known valley of death, which is where you have to scale your operations. You have to reproduce your product in multiple ways. You have to grow your team. You have to change from founder sales to a complete sales team. and you have to do whatever it takes to grow your business. And that's a massive risk that you're engaging. You will require additional funding for that, and only afterwards you get into the financial value. Hopefully, the financial value realm is much higher, but the risk to get there is also significant. These are, in our opinion, and in Minolta Advisors' opinion, the 2 points at where you can sell your company. Is that concept more or less clear? Can obviously be debated. We can do that later on. And here, since you guys are all engineers or related fields, I allowed myself to put in a complex table. Well, it's not super complex, but I'll probably not show this in a different occasion. But it's kind of trying to visualize how we think about these promise and financial value stages in terms of exit. Again, we're starting on the rightmost column here. Basically, at promise value, we know from buyers and past transactions that you can sell technology for anywhere between 50 and 100 million. Maybe it's even 20 and 100 million. But your company is not worth much more because you don't have commercial traction. The buyer is not getting revenue if he buys you. He's just getting your technology and your team. If you sell your company for 100 million, the investor needs to be able to invest at the valuation of 10 million, 10x his investment or her investment. Or if you go with a more conservative approach, if you sell at 50 million, then the investor will be needing to invest at 5 million, which is again the 10x return there. If we as an investor invest 1 million, which is our average ticket size at seed stage or at pre-seed stage, if we go in a bit earlier, we're looking for an ownership of roughly 20% or 10%. But that means that your entry valuation will be around 4 to 5 million, give or take. And then if we go into the financial value scenario, then your exit value can potentially be higher because you will be measured not upon your technology and not upon your promise. You will be measured upon what you have delivered, which is revenue. And then there is the well-known revenue multiples, not to be confused with the exit multiple. The revenue multiple means your company value is divided by the amount of revenue that you have. So, or in different words, if you have 10 million in revenue and you're a software business, which is then generating recurring revenue, today in this market environment, you have probably a 6x revenue multiple that you can get from an acquirer. So meaning your company is worth 60 million. And you can do the easy math. If you have 100 million in revenue, your company is worth 600 million. And then some investors are willing to also pay for future growth. If you've shown that you can grow 50, 100% year over year, then that compounds into this equation. But the bottom line is here, you have to say if you want to sell at 400 million and you're a hardware company where the revenue multiples are a bit lower because it's not recurring revenue, then you have to generate 100 million revenue to get to an exit value of about 40 million. Also clear, or am I too fast? And then if you can calculate backwards, you see for my ownership target of about 10%, I invest 2 million. I need to be able to invest at a 18 million valuation. And that concept, I think, is important to understand for you guys, because we see a lot of early stage entrepreneurs that come to us and tell us, well, I've built this great product. My company value is now 20 million. And then again, if you say 20 million and you're a hardware company, that implies that you need to be able to sell at 500 million Swiss francs, give or take, for us to make money with it. And I think that's extremely important to understand. On the one hand, there is several layers to it. You need to understand well who is your buyer and what problem are you solving for your buyer. Meaning, what sort of value is he putting to your company. Second thing to understand is, do you want to sell at this promise gate, or do you want to sell, or that's also often referred as tech exit, or do you want to sell at commercial stage? The third thing is, how much revenue can you make, and what are the revenue multiples that are being associated to these companies? It was different about 3 years ago. 3 years ago, a software company would have gotten 16 times their revenue, or 18 times their revenue. Now it's really 5 or 6 times their revenue, because the markets on a macroeconomic realm, as we all know, with the geopolitics today, have changed. Yeah, I think that's just generally a bit of the thinking. Of the thinking. It's not very, very complex, and it will not get much much more complex than this. I think investors are very simple minds, if you're allowed to say so, if you allow me to say so. Good. So we understood this concept. We know that here we can sell anywhere between 50 and 100 million, and here we can sell eventually much higher at 501 billion, and so on. But it requires a lot of more commercial progress. Now, what does the data tell us? The data tells us that about 75%, and this is not in relation with this. This is a different source than the chart, but it's more or less the same. It tells us that about 75% of all venture-backed companies fail. They will never return a single cent back to the investors. And maybe David has the same opinion, maybe not. We can debate this afterwards. And only about 25 to 30% of the VC-funded companies yield any return. And then on the x-axis here, you can see in what type of realms we're in terms of generating returns. So again, if I deploy 100 million in my investment fund, and I invest in 10 companies, 10 million each, and 2/3 of it, 75 million, fail, I need to, with the other 25, so that's 2.5 companies left, probably just for sake of simplicity, only 2 companies left, I need to return the other 80 million. And that's how we think in terms of math. So it's an extremely skewed distribution. This is US data, I think, from the years 2005 until 2015. It's not the most recent data, but the picture is still more or less the same. There's an extreme low number of companies that then become unicorns. Here it says it's only like 0.05%. And these are the companies that you read about in the news, right? These are the Metas and the Spotifys and the Mistrals of the world. But that's not the reality. The reality is really 75% of anything fails. It's not to demotivate you. It's just to explain you how that's again the same picture, how we think. Here are 2 examples of where VCs did great returns. Just very recently, Scale AI was bought by Meta for 15 billion. Akselos, who invested at Series A, returned 1,000 times their money. So if you put in 10 million, yeah, you can do the math yourself. And on the left side, it's a neobank, Chime, also from the US, and that also got quite some decent multiples. I think in the deep tech realm, in the not so much software realm, it's much more difficult to get to these type of numbers. It's not impossible, but it's just much more difficult. There are also good examples that we can dive into. So the question again, can you do that? And I think that's the question you will be able to answer to any type of institutional investor that you want to take the money from. Right, so now I have a bit more theory on how we think about valuations. We can dive into that. We can also just take a bit more time on the discussion. Depends a bit on the timing and your interest.
Yeah, that's super interesting.
Yes, discussion.
Like to hear about,
Yeah.
Okay.
5 minutes. Good. It will be also a bit of a repetition of what we discussed. So basically, I mentioned earlier this counting backward method. There's multiple ways on how you can evaluate your company. And what I explained before in the table was the number 2, the VC method. But then there's also other approaches that are being used. in theory. This is a slide, I think, from PwC on when you use which type of valuation method according to the stage you're in. The reality at Verve looks like this. We don't look at any discounted cash flows. We don't look at market multiples. We don't look at cost approaches or scorecard valuation methods. This is what you learn in a course at university, and this is the reality. So I think if you talk to VCs, you don't need to prepare a DCF, a discounted cash flow calculation, because they will just not look at it. You can spare that time, but instead focus on comparables. What type of other companies are out there that have followed a similar trajectory that I can compare myself to be able to convey a believable story. And then, as I said, the VC method and the market multiples, what type of exits have been in my field that show that there is someone else be able even to pay a large sum. Again, imagine if you're selling for 200 million, your buyer, if it's a trade sale to Nestlé or to any other firm, they need to have 200 million on their balance sheet, basically, to be able to finance the acquisition. And there's not that many companies out there that have that much money on their balance sheet. And most of these companies are public, so you can just also check their shareholder reports and see how much money they have on the bank accounts, right? It's fairly simple. And then in your area in your industry, there's probably about 10 buyers. It's probably not more, maybe it's 20, maybe it's even 5, but it's a handful of buyers that you should know each and every single one of them. You should know how well financed they are. You should know how well they're progressing in terms of commercial progress on the market, and then understand their problems and their needs. And in an ideal case, at least ideally for early stage, but must for later stage, you have also spoken to them and you understand their decision dynamics. So these two methods are being used. The VC method for all stages and the fixed range and comparable method for all stages as well. Yeah, I think that's the short version of this extension. Cool, thank you.